Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is this fast-growing popular restaurant a good investment? In this video we will be analyzing if Cava stock is a buy. Could Cava, stock ticker symbol CAVA, really be the next Chipotle? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Cava. Cava Group, known for its flavorful and customizable Mediterranean meals, began its journey in Maryland in 2011. The founders were three friends who were inspired by the healthy and vibrant cuisine of the Mediterranean. Their first Cava restaurant quickly gained popularity, and the focus on fresh, high-quality ingredients continued to drive their growth. Cava offers bowls, salads, and pita wraps with a variety of proteins like grilled chicken, lamb meatballs, and plant-based options. Customers can personalize their meals with a selection of dips, spreads, and toppings inspired by the Mediterranean. They leveraged this growth to become a publicly traded company in 2023 on the New York Stock Exchange. Today, Cava Group operates over 400 locations across the United States, with its headquarters remaining in Rockville, Maryland. Now let's look at the price action. Starting with the 1-year chart, we see that Cava had a CAGR of about 57%. Cava is one of a handful of newly public companies that have performed well enough to now trade above the IPO price. This company has been a great growth machine. If we perform a backtest comparison of investing $10,000 in Cava versus the S&P 500, we find significantly stronger results for Cava. A $10,000 investment in Cava would have grown to $22,650, compared to $12,450 for the S&P 500, translating to a compound annual growth rate or CAGR of 126.50% for Cava and 24.50% for the S&P 500. Cava's investment also exhibited higher volatility, with a standard deviation of 71.73% compared to 14.59% for the S&P 500. This higher volatility was accompanied by greater annual gains, as Cava's best year saw a 115.80% increase compared to the S&P 500's 15.23%. Even during its worst year, Cava only fell 4.96%, while the S&P 500 declined by 8.05%. The maximum drawdown, which represents the largest peak-to-trough decline, was also worse for Cava at -46.37% compared to -8.32% for the S&P 500. Finally, Cava significantly outperformed the S&P 500 in terms of both the Sharpe ratio, 1.44 versus 1.22, and the Sortino ratio, 2.66 versus 2.33, indicating superior risk-adjusted returns. Overall, Cava has significantly outpaced the S&P 500 across nearly every metric. Now let's hop over to market share and take a look at Cava's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Cava is categorized as a fast food restaurant. Expanding the fast food tab, we can see that Cava has the third smallest market share of the fast food companies listed, but it is gaining market share very rapidly. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Cava, CAVA, and see that the market share is just 0.09% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Cava attracts very little food spend but has been growing market share. The 5-year market share CAGR for Cava is 15.24%. This means that Cava's market share is outpacing growth in the wider industry. If we start in 2020, we see that the market share was 0.058%, 0.067% in 2021. 0.068% in 2022, 0.085% in 2023, and down to 0.092% over the trailing 12 months. Cava seems to have really hit their stride in 2023 and continue to grow at a fast pace. Let's take a look at the fundamentals to learn more. Gross margin is 37%. This is similar to other fast food restaurants. Revenue has compounded at around 21% over the past 4 years and has reached over $785 million most recently. Cava's revenue growth has been very nice and steady. I love it. When we look at cash flow, we see a 347% CAGR during the recent years for operating cash flow, while capex has worsened at a 45% CAGR. As a result, free cash flow has improved at an 29% CAGR. Cava actually looks pretty good here. The growing operating cash flow is really key as the company looks to be pulling back on capex spend just slightly. This will accelerate the move to free cash flow positivity. If the company keeps the current rate of free cash flow growth, they should reach positive status in a year. Weighted average shares outstanding have grown massively during the recent years, going from 700,000 shares in 2021 to 92.5 million shares most recently. Cava rapidly increased its share count by going public in 2023. Dilution since IPO has negligible. Now let's view return on invested capital. Return on invested capital has grown from 2.4% in 2023 to 3.5% most recently. While this value is not that great, given its status as a newly public company, Cava is doing a great job efficiently driving returns from its investments in the business. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -7 days in 2022 to -8 days most recently, Cava has actually gotten more efficient over time. I like this a lot. Last, let's look at Cava's debt. The net debt to EBITDA has increased over time, going from -55.9 in 2020 to 0.3 most recently. As Cava has become profitable, the net debt to EBITDA is now positive. Clearly, management has the debt under control. Cava looks really good. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the food fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Cava. It is a restaurant company with a gross margin of 37%. Since Cava IPO'd in 2023, the per share metrics are somewhat off. Given the minimal shareholder dilution during its few quarters as a public company, I will use general revenue and free cash flow values. So revenue CAGR of 21% and the cash flow CAGR of 29%. A return on invested capital of 4% is very low but improving quickly. Next, the cash conversion cycle of -8 days is beautiful and is only getting better. Concerning debt, a net debt to EBITDA of 0.3 means that Cava could pay down its debt with around 4 months of earnings. So from a fundamental standpoint, Cava looks very good. Now let's switch our attention over to valuation. Cava is massively overvalued relative to the S&P 500 with a ratio of 6.9. The price to earnings growth, or PEG ratio, is 8.3, indicating that Cava is overvalued relative to their projected earnings growth. Clearly Cava is a huge growth story with robust share price appreciation to match. The balance sheet is strong and the fundamental metrics are only getting better. My only concern with the fundamentals of the company is the capex spend. Cava has been spending very aggressively to open new locations. A recent Motley Fool article notes plans to open 50 new locations in 2024, which is about 16% year-over-year unit growth in order to reach management's goal of 1,000 restaurants by 2032. If revenue growth cannot keep up with the rate of expansion, then I would expect to see a reversal in improving free cash flow. Regarding the growth, despite having stellar market share growth, Cava is far from the fastest growing restaurant company. In fact, Dutch Bros, Shake Shack, Sweet Green, Texas Roadhouse, First Watch, and Kura Sushi are all expanding market share at a faster rate than Cava. If we compare the capex to operating cash flow among those 7 companies, we find some interesting results. Cava was spending on capex in the high teen percentages but recently reduced spending and is now more in line with the other restaurants. What I ideally would like to see is rapid market share growth with efficient capex spend, indicated by a low capex to operating cash flow. So in this case, companies like Texas Roadhouse, First Watch, and Shake Shack are expanding market share much more efficiently. The good news is that Cava has been improving capex to operating cash flow over time, so hopefully that trend continues. Last, we definitely need to talk about valuation. With a Cava PE to S&P 500 PE ratio of 6.9 and a PEG ratio of 8.3, Cava is very overvalued. While fast-growing companies often command a premium, Cava is just too expensive for my tastes. Unfortunately, me thinking the company is overvalued does not mean the share price won't go higher. While I am very seduced by the great potential in this company, the high valuation gives me pause. Still, I am putting Cava on the watch list, but I'm waiting and wishing for a massive drop in valuation. Many thanks for watching. What do you think about Cava and its high valuation? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.